right, we are back and it's day 2 of the DA policy conference and on the table for discussion is the party's proposed economic justice policy. With this policy, the DA intends to use a global recognition model enjoying the political support of companies and governments around the world. The first day of the conference focused on the principles and values that will guide the party to the 2021 local government elections.
We are halfway through day 2 of our policy conference. It's an historic occasion with our Federal Council and many other office bearers on the platform, the virtual platform, discussing policy proposals more in depth than we have ever had it before. We've done a lot of research. There are exceptionally good contributions in terms of written policy papers and in terms of amendments that are being debated and passed. Yesterday, we did not so much discuss policy. We fleshed out the principles in our constitution that are already there, and we gave them some substance and meaning. Today, we are doing our backbone policy. We are doing our economic inclusion policy, which looks at the number one crisis in South Africa, the economic exclusion of millions of people from being able to earn a decent living, put food on the table, and provide for their families. So we're looking at livelihoods and progress on that basis in the DA's way, which is a clear alternative for South Africans to support. We believe it is the way to get South Africa working, all of South Africa, in jobs, and look forward to a much more prosperous future.
Young investors today who wish to begin a savings plan face a bewildering array of investment options. There are not only thousands of products and services to choose from, there are almost as many different firms and vendors that market them in various capacities. With this on the rise and the rise of the gig economy and freelancing about to compromise 50% of the workforce, the future is uncertain for young adults, and it's important for new investors to understand the basics about various types of financial products, including stocks, bonds, and mutual funds. So for more on this, we are joined via Zoom by Avi Kay, who is a financial advisor at Discovery. Thank you very much for coming to our program, sir.
Wonderful. Thank you very much for inviting me.
For someone who just wants at basic level to start a savings and an investment portfolio, where should they begin?
As you said in your introduction, there is a plethora of product out there. There are many, many companies around today, and it is overwhelming. It really is. And my advice would always be, ask around, speak to people that you know, speak to people who you look up to who have done well in this area, and ask them who they're using, who their financial advisor is, and go and sit down with that individual. There needs to be a connection. You need to feel comfortable. You need to feel that the person is giving you the time of day and understands where you're coming from. And don't be embarrassed if you're coming with 200, 300, 400 rand. You've got to start somewhere. And if that person doesn't appreciate that, then there's other people to go to. But you've got to start somewhere. And for someone who hasn't saved at all and is looking to save right from the very beginning, when we use the term savings, I would go straight to the bank. And I would say to your bank that you want to open a separate account. You want to put money in every single month directly after you get paid. What is the interest on that money that it's going to earn? What are the fees in that fund in that account? And let that start ticking over. Get used to money being separated from your income, going into a separate account, and watch it grow as it gains interest. By doing that, you also have no risk. There's no market fluctuations. Yes, interest rates can go up, they can go down, but that's really not going to make a material difference for smaller amounts. So most importantly, just start saving.
Sorry to come in there because, you're talking about people speaking to their banks about investing, but if you could see a number of cases of people who get duped by people who are overnight investment advisors all of a sudden, and how they take large sums of money to invest and the money disappears like those people who disappear in the flesh. Why is it that our people are so susceptible and gullible to just, pedestrian investment advice?
there's two things: fear and greed. People are fearful and not quite sure what to do. Someone comes along, tells a great story, looks very flashy, shows great graphs, got all the techno gizmo that really baffle people, and people buy into that. On the other hand, people can say, look, I've done very poorly over the last while. I'd love to do better, and this person promises you more. In South Africa, we are very, very blessed. We are very well regulated. Everybody needs to be have a proficiency test that's done. They need to have a license. So the first thing you need to ask is, where's your license? Is it with a particular company? And there you can look for companies like Old Mutual and Liberty and Discovery and Momentum. Or is it with a particular bank? Or they could be an independent broker, and then they get individual licenses. But if they can't produce those and they can't show it to you, run a mile. And also, if it sounds too good to be true and it's too flashy, then just don't go there. And take your time. Take the information. If a person from a company gives you information, go on the web, check it, verify that it's there. Even call the company and say, hi, does Avi Kay work at your company? And if the answer is we've never heard of him, then you know you've got a problem. And especially with larger amounts, people are fearful, people are just looking for a safe haven, and people make mistakes like that. So just make sure that everything is above board, and it's very easy to check that.
You know, sometimes you would see this coming from people that you didn't expect to hear that from. Somebody getting a severance package, and all of a sudden they want to employ a DIY approach to growing their investment package. And they want to do investments directly on the JSE. And some are saying these institutional investors are a waste of time. They want to make money, invest today and get a profit tomorrow. What do you say to those people?
Okay. First of all, if you're going to go into the stock exchange, you need to know what you're doing, and you need to be prepared to take what comes your way. There's no sure bet. There's no sure share. Yes, there are blue chips that have got a historical pedigree and tend to do well. But please, if you've got a sizable amount of money, go and find someone who's a stockbroker who can advise you. On your other point about people getting severance packages and then trying to do it on their own because they just feel they're being ripped off everywhere else, let's quickly break that down. There's two areas of fees that you will pay. You will pay a fee to the institution, and together with that, you'll pay a fee to the fund that you're investing in, and then you'll pay an advisor fee. So you can either pay an advisor fee up front together with an ongoing fee, or there can be a hybrid of both, only upfront or only ongoing. There's different ways of doing it. But what you need to look at is your total cost of that investment going forward. And just to use a very simple example, and I don't mean to be disparaging, but it sort of illustrates the point nicely. When you go into a dealership to buy a car, and there's one model with 3 different engines, a 1.3, a 1.6, and a 2-liter turbo, you need to understand the risks that you're taking. The 1.3 is going to be boring. It'll get you from point A to point B, but there'll be no thrill in the drive. On the other extreme, the 2-liter, you've got to be careful, because if you don't know what you're doing, you're going to have an accident. And the one in the middle should have just, be able to give you a little bit of both, but nothing on either extreme. So too with investments. If you're looking for a quick fix and you're going to go into aggressive funds to try to do nicely, all you need is COVID-19 to come around in March 2020, and you do nothing. In fact, you go backwards for 5 months, and now you're trying to make it up. Yes, it should recover, but you need to have the guts and the appetite to go through that volatility. On the other hand, you need to make sure that you are doing better after costs than you could have done if you put your money in the savings account. And that sounds simple, but it's not. It's been a big ask the last 3-4 years. Money markets have performed well. Interest rates have been relatively high until COVID. So you've done nicely. Yes, there's a tax implication, but be that as it may, you're getting a surefire return every month. Your money's growing, it's compounding. Whereas if you went into more risky equity-based funds, it could have been a lot more bumpy. But again, if you don't understand these things, you need to find someone who can sit down and put them out in a simple way for you. And again, not like the person will meet with you today and you have to invest this afternoon. If you don't do it by 5 o'clock, the special offer is gone. It doesn't work that way.
All right, tell us about people who are not ready to invest but they want to. Say, for example, those who don't get their house in order, they still have debts and they want to even use grocery money to invest. Some get loans to invest and they become so desperate for results when they do that. Talk to us about those kind of people and their level of desperation and why they should not even try it.
Okay, so we have especially right now, we have a phenomenon in South Africa where there's too much month at the end of the money. It might sound a bit funny, but that's what happens. People are not earning enough to get through the month. People get to the end of the month, they're borrowing money, they're going into debt, they're putting groceries on credit card, they're putting groceries on shop cards. And now you say to this person, well, you're never going to be able to retire if you don't put money away. And they look at you with tears in their eyes like, there's nothing more I'd love to do than put money away for retirement. But I just got whacked now 2 days ago for school uniform, and then there's school books, and then there's deposits for university next year. Where's this money going to come from? And my answer there always is that if you can somehow squeeze out a small amount that gets put aside on a monthly basis, that gets taken off directly before you can touch your money, no matter how small the amount might seem to you, it will grow. 100 Rand becomes 1,200 Rand at the end of the year. But if the money is so dear to you, please be careful where you put it. And don't be aggressive with your outlook. Be more conservative. Rather take a little bit less growth but get more certain growth. But again, it's a very heart-rending dilemma that every financial planner has, where you do a financial plan and you look at the retirement and the person just says to you, I wish I could. But on the other hand, where people are not saving simply because, as you said, they haven't got their house in order, they just haven't got it together, then even if they're paying off debt, as long as you have a plan how you're managing that debt, start putting away at the same time, because life will happen. You'll pay off that debt and there'll be another reason to get yourself into another bit of a mess. And then you'll never start retiring or putting money away for savings. And the secret is the longer the money sits, the more it compounds, or the more units you acquire in your portfolio, the better growth potential it has. So start doing it early and do it in small, manageable amounts. But don't be overly aggressive. Right. Just again, often people have retirement funds at work and they think they're fully taken care of. I see it all the time. First of all, many of those funds give you really detailed and simple printouts as to where you stand, what you'll have when you retire, how much you'll be short, how much extra you should save. Those printouts aren't done, just to make the presentation look good. They're very, very important. If you can take heed of them and you can maybe go to your HR and say, please increase my savings towards retirement by a small amount, and you've discussed it and you really feel that it won't affect your cash flow at home, let's do that.
Okay,
because
Avi,
the more you can pay, the better.
You're right. Avi, thank you so much for that insightful financial advice, so to say, and we appreciate your time. Avi Kay is a financial advisor at Discovery.